Welcome to this explainer, where we're going to decode the secret language of the financial markets and answer that fundamental question, what is candlesticks anyway? Look, if you've ever pulled up a trading chart and felt like you were just staring at the matrix, trust me, you are not alone. But today, we're going to turn those confusing, flickering charts into a crystal clear story. We're going to break down the ongoing minute-by-minute battle between the bulls and the bears and show you exactly how to read who's actually winning. We have a seriously packed agenda today, split roughly into 70% tutorials, 20% strategy, and 10% market psychology. We'll be hitting 1. Decoding the candlestick, 2. Anatomy, bodies and wicks, 3. Standard versus hollow candles, 4. Strategies for pattern recognition, 5. Trading the Tsuki gap, and finally, 6. The psychology of markets. Let's get right into it. Starting off with Section 1, Decoding the Candlestick. Okay, so you really can't read a sentence without knowing the letters first, right? So let's lay down our foundational basics and learn our financial ABCs. Every single candlestick you see on a chart is, quite frankly, a data compression masterpiece. It represents a specific time frame that you as the trader get to define. That could be 1 minute, 1 hour, 1 day, or maybe a whole week. Within that exact window of time, the candlestick captures 4 absolutely critical data points. The open price when the session began, the highest price it reached, the lowest price it dropped to, and the close price when that session ended. In the trading world, we just call this OHLC. Instead of looking at a boring, simple line chart, this gives you a 4-dimensional snapshot of exactly what went down during that time frame. Moving right along to Section 2, Anatomy, Bodies and Wicks. So structurally, a candlestick is divided into 2 main visual elements. First, you've got this thick, rectangular part right in the middle. That's called the real body. It maps the absolute distance between the opening price and the closing price, telling you where the real substance of the trading took place. But look just above and below that body. You'll see these thin lines extending out. We call those shadows, or wicks, and they are incredibly important. The upper shadow shows you the extreme high the price attempted to reach before getting pushed back, and the lower shadow shows the absolute floor it tested. Basically, it shows you exactly where the price tried to go but just couldn't hold. Now, the absolute easiest way to read the actual momentum of a session is through color. Honestly, it's a lot like a football game. When you see a green or white body, it means the close was higher than the open. The buyers, the bulls, won that session and marched the price right up the field. But when you see a red or black body, the close was lower than the open. The sellers, the bears, were in total control and drove the price down. And the size of that body? That tells you the margin of victory. A massive green candle means the bulls completely dominated from start to finish. But hey, what happens when it's a tie game? When the opening price and the closing price are virtually identical, you get what Japanese traders call a doji. It forms this little cross or plus sign shape with almost no real body at all. A doji is the ultimate symbol of market indecision. The bulls pushed, the bears pushed back, but honestly, neither could gain any ground by the time the clock ran out. Depending on where a doji shows up, especially if it's after a long sustained trend, it can be a massive warning sign that the current momentum is totally exhausted. All right, Section 3, Standard versus Hollow Candles. Let's see how all this builds into a really crucial evolution in modern charting. Modern platforms use a specific variation of candlesticks to give professional traders a much sharper edge. Now, standard candles are great, sure, but they only give you binary data based on a single session. Hollow candles, though, they are a total game changer because they separate the fill of the candle from the outline color. This packs 2 distinct layers of information into a single glance. The fill, whether it's hollow or solid, tells you what happened purely within that specific session. A hollow body means the close was higher than the open. But, and here's the kicker, the color of the outline compares the current close to the previous candle's close. So if you see a green, hollow candle, that is incredibly bullish. The price went up during the session, and it closed higher than the previous session. So, why does this matter? The biggest benefit is that hollow candles drastically reduce your cognitive load. Standard, solid-colored candles can easily trigger binary panic. You see a sudden red candle in a beautiful uptrend, and you instantly want to sell. But hollow candles separate that immediate, noisy session data from the macro momentum. They create a much more peaceful, detailed visual environment. By decoupling the immediate price action from the overall trend, you can avoid emotional overconfidence during a rally or sheer, unadulterated panic during a sudden volatile drop. Okay, we've mastered the alphabet. Now we're shifting into the 20% strategy portion of our explainer with Section 4, Strategies for Pattern Recognition. Let's start forming actual words by combining these candles into strategic patterns. See, traders don't just look at candles in isolation. They look for specific sequences that historically predict where the market is going next. For instance, you have the hammer. This is a single candle pattern with a small body and a long lower wick, usually forming at the very bottom of a downtrend. It signals that sellers tried to push the price down, but buyers have violently rejected it. Then you have multi-candle patterns, like the highly reliable engulfing pattern, where a massive candle completely swallows the body of the previous one, showing a total and sudden shift in market power. Or the three white soldiers, which is an awesome three-candle sequence that signals a really strong bullish reversal. But sometimes, the market moves with such violent momentum overnight or between sessions that it literally skips price levels entirely. The open of the next candle is dramatically higher or lower than the previous close, leaving this big empty space on the chart. Japanese traders call this empty space a ku, or a window, while Western traders typically just call it a gap. When a small spinning top candle, known as a koma, gaps away from the pack like this, it becomes a hoshi, or a star. This indicates the market has become highly unstable and a major reversal might be right around the corner. Which leads us perfectly into Section 5, Trading the Tsuki Gap. Let's dive into a highly specific, actionable multi-candle strategy that takes advantage of these windows. It's called the Tsuki Gap, and it is an incredible tool for confirming that a trend is actually going to continue. The Tsuki Gap is a three-candle continuation pattern. Here's exactly how you spot it. Step 1, you need to see a strong existing trend confirmed by a long, confident candlestick. Step 2, the very next candle must open with a noticeable gap in the direction of that trend, and it has to close in that same direction. Step 3, well, this is where the magic happens. You wait for a third candlestick that moves against the trend, a corrective candle. This candle will dip back into the gap to test it, but it will fail to close the gap completely. That failure, it proves that the counter trend is weak, and the primary trend is ready to roar back to life. Now, when you are actually executing a trade based on the Tsuki Gap, risk management is absolutely everything. The strategy dictates that you enter the trade just as that third candle confirms the gap is going to hold, but you have got to protect your capital. A standard professional strategy here is to aim for a 1-to-2 risk-to-reward ratio. This means you expect to make 2 units of profit for every 1 unit you risk. You ensure this by placing your stop loss just on the other side of the gap. If the price falls through and fills the gap, the pattern is invalidated, and you just get out safely with minimal damage. Simple as that. Finally, for the last 10% of our explainer, Section 6, the psychology of markets. We are going to pull back the curtain on why this entire system actually works. We're going to read the room and understand the deep underlying psychology behind these shapes. And honestly, what blows my mind is the origin of this visual data. These candlestick patterns, they weren't invented by some Wall Street algorithm in the 2000s. No way. They were developed in the 18th century by Japanese rice traders, most notably a brilliant merchant named Munehisa Homa, who codified them into what is known as the Sakata method. Homa realized that market prices weren't just based on the cold arithmetic of supply and demand. They were deeply driven by cyclical human emotions like fear, greed, and indecision. I mean, it is absolutely fascinating that the exact same geometric patterns that tracked 18th century rice markets in Japan are identically mapped onto modern cryptocurrency and forex markets today. You really have to remember, you aren't just looking at math, and you aren't just looking at arbitrary geometric boxes. You are looking at a real-time global negotiation of human emotion, printed directly onto your screen. When a lower wick is incredibly long, you are literally seeing the visual footprint of one crowd's panic being completely overpowered by another crowd's greed. The technology changes, the assets change, but the human nervous system's reaction to financial risk, that is a constant. So, what does this all mean for you? The next time you open up a financial chart, don't just see a random jumble of red and green lines. Remember that you now have the tools to read the language of the crowd. Look at the bodies, measure the wicks, spot the gaps, and ask yourself, what story are the buyers and sellers telling you today? Are they confident? Are they terrified? Are they undecided? Once you can answer that, you stop guessing and you start truly reading the market. Are you ready?